In the current global whirlwind of modern investing, a three-fund portfolio allows you to diversify your holdings across domestic equities, foreign stocks, and domestic bonds. A three-fund method, such as a target date fund, gives greater control and diversity than a single fund approach. However, the two-fund portfolio can also serve as a reasonable substitute for a three-fund strategy in specific circumstances. Hi, my name is Fred, and if you're interested to find out why both the 2 and 3 fund types of portfolios are generally favorable, what differentiates the two concepts, and when you should pick the 2-fund portfolio over the 3-fund portfolio, make sure to watch until the end of this video. Don't forget to hit like and subscribe, and turn on our notifications bell so you won't miss out on any new releases from our channel. Let's get started. Think of the 2 and 3 fund portfolios as co-emperors, one of which is more conservative than the other because of the difference between the type of assets that are kept inside. A 3-fund portfolio includes a total US stock or S&P 500 index, a total international stock index, and a total US bond index as well. In contrast, a 2-fund portfolio only carries 2 of the 3. The total US stock or S&P 500 index and total international stock index. Undoubtedly, a portfolio with more stock-based funds will be more aggressive. Here is a quick list of possible Vanguard, Charles Schwab, and Fidelity 3-fund portfolios. Simply remove the bond index fund from that list if we're talking about the 2-fund portfolio. The main distinction between these two funds is their position on bonds. Given the rising interest rates and inflation, one may think that bonds are worthless and shouldn't be held. This is not true. Yes, bonds suffer from higher interest rates and from excessive inflation. However, it still makes sense to maintain within a 3-fund portfolio, which we will discuss later. The 2 and 3 fund portfolios have several benefits in common despite being highly distinct from one another. The first is that both corporations' stock portions collectively own 11,768 equities for businesses based all around the world. Your money is immediately diversified throughout several businesses, industries, nations, and even currencies as a result. Although diversity is sometimes portrayed in headlines as an investor's greatest enemy, it actually lowers your risk of being overexposed to any of the several elements I just outlined. There is no portfolio overlap since you have one US stock fund to manage the US-based firms and one international stock fund to manage the rest of the globe. If you have a bunch of haphazard funds that hold too many stocks for you to keep track of, your diversification may suffer from too much fund overlap. The cost-effectiveness of the 2-fund and 3-fund portfolios is also noteworthy. You would only pay 30 cents and 80 cents, respectively, each year for the entire US stock index and total worldwide stock index for each $1,000 put into the Vanguard ETF equivalents. In contrast, for every $1,000 invested in a pricey actively managed fund like ARKK, you would pay $7.50 annually. For instance, an actively managed fund that costs 0.75% annually is 25 times more expensive than a Vanguard Total Stock Market ETF. These 2-fund and 3-fund portfolios don't depend on a fund manager to effectively acquire and sell stocks that are held within the fund because they track an underlying index. As a result, the fund manager risk connected to actively managed funds is instantly decreased. The main distinction between the two portfolios is that the 3-fund portfolio includes a bond fund allocation, whereas the 2-fund strategy does not. Many people possess the belief that bonds are no longer valuable, and thus one shouldn't own any. Bonds are indeed in a poor situation because rising interest rates reduce the value of bonds, and that trend is anticipated to continue. To top it all off, the current 8.5% inflation rate seems too excessive. This means that if inflation is 8.5% and your bond yield is just 2.5%, your real rate of return on investment is 6%. Sure, this seems horrible on the surface in this particular moment of time. A good investment that you can definitely make right now is our excellent membership program. You'll have complete access to exclusive features and perks available on our channel, and giving us a super thanks will highlight your comments on our channel. Back to the discussion about the 3-fund portfolio. Before I tell you when not to utilize the bond element of a 3-fund strategy, 2 points need to be made. First, when it comes to investing in bonds, our thinking needs to be the same as when it comes to stock-based index funds. What happens to our assets in the short term is meaningless to us since we should be long-term buy-and-hold investors. When monthly stock returns were negative from January 1988 to November 2020, monthly bond returns were positive almost 71% of the time. Bond investments might not seem enticing right now based on current returns, but always keep in mind that we're investing for decades, not just a few days. Second, bonds continue to perform the same function in a portfolio, which is to lessen volatility from the stock-based index funds we own. An alternative plan of action like putting money in gold or cash will only leave it to be consumed by inflation. Dividend companies are also subject to stock market volatility, just like your index funds, therefore investing in them doesn't make a lot of sense. Furthermore, Bitcoin is much more erratic than stocks, therefore allocating any of your bond portfolio to this cryptocurrency is a risky move. Stay the course and tune out the noise if you have a band allocation. Despite the fact that I just emphasized bonds in a 3-fund portfolio, I'm about to flip that and mention that if you're younger, a 2-fund strategy would be a far better choice. The stock market's volatility is more to your advantage when you're younger. Some investors aren't major supporters of investing any money in bonds during the accumulation phase since doing so would cap your investment returns' potential gains. It should be mentioned that it is indeed preferable to start investing in a straightforward 2-fund portfolio composed of a US stock fund and an international stock fund before finally switching to a 3-fund strategy down the road. However, if you're younger and feel comfortable investing a little portion of your income in bonds because it better matches your investing style, there is nothing wrong with that. Is it perfect in terms of returns? Without a doubt, no. But creating a portfolio that we can emotionally cling to during good and difficult times is more crucial. Your opinions on the 2-fund and 3-fund portfolios are very much welcome. Would you prefer utilizing a more reserved 2-fund portfolio or a more aggressive 3-fund portfolio? Comment below and let us know. Thanks for watching, and please consider leaving a like and subscribing if you want to stay up to date on the newest investment videos on our channel. Curious to know more about Vanguard index funds that you can purchase in 2022 and 2023? Check out this link to discover the 6 best Vanguard index funds you can purchase for your index fund investing in 2022 to 2023. We'll also talk about Vanguard ETFs, which are excellent alternatives to index funds. Click and watch the video to learn more.